I started this portfolio 1,460 days ago with a simple task in mind. I want to retire early with passive income, and since then I've invested $50 every single week for the last 4 years. And in this video, I'm going to talk about what I learned in those 4 years, the mistakes I've made, and my future plans of how I'm going to bring this $13,700 portfolio to be worth over $2.3 million with just $50 a week in contributions. So I'm going to show you how that's possible. I'm going to talk about the evolution of this portfolio and how my investing philosophy has changed pretty significantly since I started it. So let's get right into it. The phase one, years 1 through 3. During years 1 through 3, I kind of had the same philosophy the entire time. Dividends, dividends, dividends. I was obsessed with them. And dividends are great and they're still near and dear to my heart, but they probably weren't the right strategy for me at the time. When I started the portfolio, I was really interested in passive income, and I wanted to have a portfolio that paid for my life so I could retire early. And that's still kind of the goal. But when I started it, I was buying stocks like Johnson & Johnson, Procter & Gamble, JP Morgan, Chevron, which are all good companies, but they don't realistically have the ability to, say, double in value in a short period of time. When I first started, I was earning sometimes less than $1 in dividends. Last few months, I've been earning upwards of $40 a month. So that seems like good progression, but realistically, that's not doing a lot for me right now. And the growth potential I'm putting on the table isn't worth that amount in dividends. These dividend stocks are really great to hold when you're already retired and you have that capital to make enough dividends to pay for your income, pay for your life. But because I'm so young now, I don't have that capital. These dividends aren't paying any of my bills, so they're really not necessary to have. So while I was 16, 17, 18 years old, I was investing like a 60-year-old. And in that time, my returns were about 10.5% per year on average. And that's actually above historical averages, or right around there. But in that time, the S&P 500 got over 12% a year in returns, so I was underperforming the market. This means I would have made more money just sticking all that money in a S&P 500 ETF, which is what I do in my Roth IRA and some other ETFs, but this portfolio was trying to be something I could do to outperform the S&P 500. So what I learned in years 1 through 3 were that dividends are great, but they shouldn't be used for someone who's young and has a long investing horizon. Someone who's young and has a long investing horizon should be investing in slightly riskier plays because they can make more money long term, and if they lose money in the beginning, you have plenty of time to earn more and make up for that. So that brings us to year 4, which was exactly 1 year ago today, where I changed the portfolio and rebalanced it to be more growth focused. This was at the start of Donald Trump's second term in the United States, and I was trying to base my portfolio around his policies and what I thought his policies would be and how they would affect some industries. So for example, I bought some oil stocks, I bought some bank stocks, with the idea that he would have favorable policies and these stocks would perform well in the short term, like a 1 to 4 year range. So if you are not living under a rock, you know that this first year of Trump's term has been anything but predictable. And in that time, I have underperformed the S&P 500 again, or the market in general. That's because I've been going about this all wrong. Something I've always known is even the smartest people in the world can't consistently outperform the S&P 500 or the market at a short-term basis. And the biggest hedge funds can't do it. I thought I could. I was wrong. So this last year, I got outperformed. I think it's important to mention that my Roth IRA is worth about $1,000 more than this portfolio, and it's about 90% in ETFs. So I do have that kind of safe, strong diversification that is still keeping up with the market. I think it's important that every investor does that as well and has a lot of ETF exposure. But in this portfolio, the goal was to pick stocks and outperform the market. I need to be thinking long term. That's when people actually can outperform the market. So that brings us to the next phase of this portfolio, year 4 and beyond, and how I recently just made a portfolio recomposition based on this theory. I'm picking stocks that I think have good value, and I think the company itself will grow long term. And I also based a lot of these picks on the AI industry. It's pretty clear that AI is just going to become more and more prevalent in our lives, and it's important to have a lot of exposure to it, especially if you're young. Now, I know there's a lot going on right now. The US is at war with Iran. Everyone thinks we're about to have an AI bubble. There's an affordability crisis. And I do think, like I mentioned in my videos before this, that there will be some type of AI correction, but people have been saying that ever since year one for my portfolio, and they've been wrong pretty much every time. There's not been a crash in the last 5-6 years, I guess, since COVID, and people have been predicting it every single day since then. No one's going to be able to tell you when this crash happens, and you just need to be invested in it the whole time and be ready to invest more when that happens. So I picked some stocks I believe will do really well long term, can survive a crash, and have good AI exposure and other diversification, so I can capitalize on that theory and hopefully outperform the market with this portfolio. My last video was a deep dive onto each of the positions and my reasoning why, but I'm still going to show you them right now in this video. So here's my portfolio. 20% SEHD, 16.92% Regeneron, 16.2% Amazon, 14.65% Microsoft, 10.16% Google, 9.15% Visa, 9% Cameco Corporation, 2.5% SoFi, and 2.5% Applied Digital. So these are all companies I believe have long-term potential for a lot of growth. I believe they could survive a market correction and thrive in the aftermath. Here are the sectors I'm invested in, including SCHD, which is an ETF. I've got about 20% in healthcare, 17.9% in consumer discretionary, 16.5% in information technology, 13.5% in financials, 13.1% in energy, 11% in communication services, 4.2% industrials, and 3.5% in consumer staples. So that's what my spread is looking like right now, and this gives me a lot more room for growth. Unfortunately, I did lose out on some dividend income, and my dividend stats are a lot lower now. So right before I made this change in the portfolio, the yield was around 2.48%, and the yield on cost was around 2.84%. My annual dividends were about $336 a year, or about $28 a month if you average it out. That was pretty good, and I wish I was able to keep the yield that high, but the trade-off for more growth were stocks that paid less in dividends, because they're taking that money they would have paid in dividends and reinvesting it in the company for more growth. Now my dividend stats are looking a little weaker. So the yield is about 1%, and the yield on cost is still around 1%. Average annual income from this portfolio has gone down to $135, and that's about $11.28 monthly. So I have less income, but either way, this income is just getting reinvested back into the portfolio. It's not like I'm taking it out to use on bills, and personally, I think that's worth it. But we still had 4 really good years of dividend growth in this portfolio, and I actually have all the data from the last 4 years to show you what someone who wanted to invest in dividends could achieve in their first 4 years. So here's a spreadsheet I made to show you. In year 1, I got about $67.80 in dividends. Year 2, that grew all the way to $179. So you can see dividend income itself actually has a lot of compound growth. In year 3, the dividend income grew all the way to $262. Now that was the peak of the dividend focus. Last year, I kind of took a little bit of focus away, so the dividend income only grew to $306. But in those first 4 years, the portfolio made $771 in dividend income, and I think that's pretty good. You can see the progression from 2022, where I was getting $2.25, 86 cents, $2.40, to all the way to the end of 2025 and 2026, where I was getting $41, $31, $5, $45, $31, etc. So if you are really focused on dividends, you can maybe scale the numbers up and see how your portfolio would grow over the first couple of years. But we can't forget about what I said before. This portfolio is currently worth around $13,700 roughly. So how can I get this portfolio to $2.3 million by only investing $50 a week? Well, that's because of compound interest and how it could actually be more important than dividend income. If we look at my portfolio statistics, this portfolio grew nearly 12% every year. So how can that actually add up to $2.3 million? Well, let's look at how much money I made each year. In year 1, my portfolio profited about $80, and in that time it was worth around $2.7 thousand. We took all the contributions and all the profits, and it got reinvested, obviously. So by the next year, I made even more money. Now, the portfolio made over $600 in just the second year, over a $500 increase in 1 year. That money you contributed gets reinvested, and the money you made gets reinvested. In year 3, the portfolio made $1,000. It's about a $400 increase from the last year. So the portfolio started at $6,000. You take contributions, you take the profit, and now the portfolio is worth around $9,000. Finally, in year 4, the portfolio made $1,800. That's an 80% increase in profit since the year before. So what's the clear message here? each year the portfolio is making more and more money in dollars, even though it's around the same percent increase. So what could this look like over the long term? Well, let's check it out. I'll take my portfolio at $13,700 and give us a 40-year horizon. By this time, I would be 60 years old. If I got an average annual return rate of 11%, which is less than I did in the first 4 years, and we invested $200 a month, which is less than $50 a week, less than $7 a day, and see what the return is, it is $2.355 million. So the main message here is even at $50 a week, you can have over $2.3 million in a portfolio set up for retirement. And at the end of the day, you want to have a more growth-focused investment for that long horizon, so that return rate can be higher, your compound return could be even more, and then at the end of that time period, when you're 60 years old or so, you can start transferring that money over to income earning assets like dividends. This could pay for your lifestyle, cover your expenses, and then you don't have to work. So I can still reach my original end goal just by doing it a little differently. If you're completely new to investing, check out this guide I made to explain and give you a solid foundation. And if you already have that foundation, check out this video. It just goes over each stock in my new portfolio and why I made those changes. So that'll give you a better understanding of what I talked about in this video. Thank you so much for watching. Peace.